Good evening, good morning, good afternoon, wherever you are. This is What's Investing, and today I'll be talking to you about dollar cost averaging, what it is it worth doing, and how and when it is worth doing, and kind of just going around the general basis of what it is. And this is all just my opinion of my young, average Joe New Zealander knowledge. So take everything with a grain of salt and do your own basis research, but this is the general idea. So here, DCA is just short for dollar cost averaging. And say you want to invest a certain amount of cash. I've just set 100,000 as the base for 10 periods. Here you will invest 10,000 every year, and this will show the investment value, and this will show your cash, and the investment value at the end is just over positive 9,800. And this is the total just throughout, with the cash plus the investment throughout the whole project. And the lump sum is essentially the other way of doing your investment, which here is shown to be much greater in this scenario. And this scenario is very specific to a market that is constantly growing at a certain rate. This is just for simplicity at 10% per year. So in this scenario, where the price of the shares are always going up, you would want to lump sum at the very start of that, but you would have to know the market very well. So for dollar cost averaging, you would always be buying the shares or whatever at a higher price, so you'd be losing out on a lot of money. And essentially, if you put 100,000 in for 1 year, you'd be better off in this scenario. So whereas in this scenario we have a more volatile market here, and the trend is not a straight line of 10% every period, where it was years in the previous one, now it's months. So in this one, if you were doing a dollar cost averaging method, which is investing a certain amount per period, which is essentially a 1/n proportion of your lump sum. So if it's for 5 periods, it's 1/5, which is a 1/1500 over 5 rather, which is 300 per month. And so in this scenario, the shares are at different prices, not growing, going up, down, all over the place. So here, where you're investing 300, it'll cost there, so on and so on. So the average cost of a share is $20. Whereas if you were to lump sum at the very start of this market, you would only get 50 shares. Whereas if you did the dollar cost averaging approach, you would get a total of 87 shares, which is much better. And this doesn't account for dividends or any of that. This is just a very simple analogy. And of course, the average shares that you'd get from doing the lump sum, if you chose any one of these months, is 87. But you'd either be below a lot or above a lot. So in a market that you understand is going to be volatile, even in the long term, it's much better to do a dollar cost averaging approach. Whereas in a market that's constantly growing, the lump sum is a far better off method of investing. And this is just another example of the lump sum versus cost averaging in a market that is pretty much constantly growing. So the blue line is the cost averaging, and the orange line is the lump sum, which you can tell it is just far better off if you're investing $50,000 straight away, I think that says. And over time, you get barely above it with this method in this certain market. Whereas if you did a lump sum, even throughout the volatile market in this scenario, you'd be much, much better off. And an exception to the growth of the, essentially lump summing in a market which you know is going to grow, you got to understand that the market could crash immediately or soon after that lump sum, and that can cause you to panic if you get emotional. So putting all your eggs in the basket straight away can be a very negative way to do it. Whereas in a dollar cost averaging approach, if the market does crash and bounce back or correct, only some of your investment would have been at the high price, and many of the other ones will be at a lower price. And you wouldn't have put all your investment money straight into that one place, which is essentially the exception to lump summing on a market you think will grow. And yeah, it's just all up to you at the end of the day. And I hope I've helped you understand how to kind of diversify your investment strategies in certain markets, and learn something new that you can share to everyone around you. And I am using a mix of both of these strategies over on Sharesies, which my previous video was on, so if you want to check that out, go have a look around there, and yeah, see you around.